Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Monday, July 21st, 2025. This webinar, we look at the sectors and the big indexes. We use a lot of weekly charts to kind of have a sense of longer term trends and levels. On Thursday, we do market trends, and that one we look at more nuanced stories, individual names, sectors, and economic trends. Just starting off with some disclosures, I'm going to share also some more items with you in the chat. Some of the disclosures you might want to check out. Let me just go ahead and turn this off. You can look at the standardized returns of some of the ETFs we're going to be talking about. And I'll also just briefly mention that TradeStation is preparing to launch Titan X, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. Titan X will be available to customers as a beta soon. If you're new to TradeStation, you can join the waitlist at tradestation.com/Titan-X or see the link in the description of this video. All right, so it's great to be with everyone. So today, if you want to go to tradestation.com, the main page here, and you scroll down, you'll see toward, about halfway down, we have things from our blog, our articles, and another sector breaks out as stocks keep rising. This is going to be an article that we're going to be kind of focusing on. A lot of the information we have comes from this article and actually ties directly into something we've been discussing recently, which is the potential for breakouts in utilities, which is exactly what we got last week. And that's what this sector is about. And we will return to that briefly. So as we look at this overall, I mean, a few things stand out to me here. I think overall the way to think about this is we are essentially in a low volatility melt up stock pickers market. This is exactly the kind of thing we've talked about. We go through the volatility cycle. We go through periods in the market is highly volatile, highly correlated. It all drops together and then it all rebounds together. And right now we're in a situation, after it rebounds together, then it makes small moves up and down, small amounts. But individual stocks, individual sectors, individual themes start to take hold, and that's what we're seeing now. So take a look here at the S&P on the daily chart. You can just see here that we're just drifting in relatively small ranges here. But to me, the key things here that really matter is the way we held this low from back here on July 7th. You can see that we went down. This is when people were worried about, Jerome Powell getting fired. We went down. We held this tight level. This is very similar to the way the market behaved, back here at other times when it would hold. This was back in late 23, early 24. It would rally and hold tight levels, rally and hold tight levels. Pullbacks were very modest. If you were a seller, it hurt you. You'd be selling and then you'd be basically seeing no follow through. And this is the same kind of environment. It suggests little, overall need to sell, little selling pressure, not very much. It's a low volatility kind of melt up. And I think what's important to realize here is that we look at our key ETFs here on TradeStation's platform. This shows us the performance in different time frames. So the 21 day is basically the 1 month return. If we look here, we can basically see technology, industrials, consumer discretionary is the leading in the last month. If we look in the last 2 weeks, it's also kind of similar. Technology, consumer discretionaries, industrials. Utilities are in there because of their big surge last week. They're usually a safe haven, but they kind of have this ambiguous nature now because they're tied to data centers and AI. So overall, I think the thing we're seeing here is the actual composition of the market behavior is positive in terms of the risk on. We're talking about how industrials have been kind of really stepping up their game as well. But we really see also over here at the industry level a real shift toward the metals, which is also risk on. Semiconductors outperforming, which is risk on. It's also interesting. I wonder if we actually have it here. If we look at, I don't have it, but we're starting to see things like strength in silver, which I just want to mention here. And I think that's interesting because that's also risk on. It shows that there's the industrial side of metals. We're not seeing the gold safe havens. I mean, gold is doing pretty well, but it's not like we saw a few months ago when gold was surging and other things like copper and stuff were struggling here. So we're in an environment here where a lot of this stuff does continue to point in that same direction. Now, I want to point out overall, let's just look at this chart here real quick. This is utilities breaking out. But here we have just S&P. I'm going to just quickly go to this. But I think to me, the thing that really does stand out here that's pretty interesting is last week we were told by CBS News that that Trump wanted to fire Powell. He quickly has to basically backpedal from that or deny it. Then there's a report that a bunch of senators basically came forward and urged Trump not to mess with Powell anymore. And then at the same time, now today we see Scott Bessent basically saying that now we need to do a review of the Fed. So it kind of looks to me just from the view of Paul. It's like a political thing. The key thing, and I think my point in all this is that the maximum bad news of the various things from the new administration seem to, from now, unless something new emerges, tariffs and interfering with the Fed. Those are the things the market was most unhappy about. Those things now we might have seen the thick of them. And I think that's the most important thing to kind of think about here is that the bad news in many ways, the scary stuff has happened. And now the question is as we look out to the next 6 months, does it remain tariffs being frightening, the Fed being, interfering with firing Jerome Powell being frightening, or do those things kind of fade in? Instead of things being frightening, we have M&A being positive. We have Fed cuts potentially coming. We have strong earnings growth. We have consumer. We have things like that maybe as we look forward, maybe the catalysts that are going to come to us are not as bad. So I think the way to think about it is it basically, we see now a diminishing of the worst case scenarios with tariffs, worst case scenario with the Fed. But it's also interesting to me is there was an article, I think yesterday, from China basically saying that their exports of rare earth metals to the United States was up like 660% in June versus May, which also kind of says that relations between China and the United States seem to be potentially improving. So I think I want to go back to something I said on Thursday and just say, there's this famous time when during World War II when Winston Churchill said this is not the beginning of the end, but it's the end of the beginning. And I think maybe that's the way to think about this, where we've been through the worst of everything now. And now it's kind of like, well, let's not say we've been through the worst of things, but if you were to just look at it, we've been through a lot and things could get worse from here. But a lot of the things that we knew were coming have now happened. So the thing is, it would require some new kind of unexpected exogenous thing now. And now, if anything were to happen, we might be more in a spot where the sentiment pendulum can swing the other way, where, if they were, if things were really going to fall apart, maybe that would have already happened. But now, without the maximum crisis scenario, we have a market hitting highs with sentiment still pretty lukewarm and a lot of negativity, a lot of cash on the sideline with the market hitting highs and the other shoe not dropping. And that creates the potential for something that will continue to squeeze to the upside. Potentially, it also creates the potential for this kind of price action, which is very tight pullbacks without continuation to the downside. This is the kind of environment that seems to be pointing towards. So I think as we look forward, we see the potential for some rate cuts. We see the potential for some consumer improvement. We see the potential for year-end, holiday shopping. We see the potential for less political risk, maybe. The farther we get into, the closer we get to the midterms, the less and less power a second-term president has. And I think that's an important thing to realize is that these sort of the shock that we've had, all those sort of things, as time moves forward, the actual impact of them, because of the nature of the cycle, could potentially weaken. And, in American politics, things often have this tendency to revert to the middle, and the most extreme things could revert toward the middle. And it's interesting just to kind of think about that here. And if that happens, is it bearish for stocks? I think that's the big question. I don't want to talk about politics, but is it bearish for stocks if things kind of, move back in the direction away from some of these early policy moves? And I think that's the bigger kind of way to think about it. As things move to the center, do the worst case scenario things play out, or do things maybe feel less worrisome to people? It's also interesting that the Fed not cutting now, but they're expected to cut in September, about a 58% probability of that, according to the futures. This Fed CME, the CME Fed Watch tool. China not cutting interest rates, but they might cut. So these things all create the potential for more positive things down the road that are not happening now, but could happen. Remember, often people will sell the news once it's happened. So in many ways, you don't want good news to happen. You want good news to be out there in the horizon, kind of pulling things in an interesting direction. And I think that's an important way to think about it. And now, as we also look forward, in this article is a few things to talk about. One of them is the fact that we basically have here is that we have this continuing demand for energy. Now, the actual stock that triggered it last week is not even in the S&P. It's called TLN, Talon Energy. I've never heard of this. It's some kind of utility stock. They acquired some gas-fired turbine, some kind of gas-fired plants, and people thought it was a great thing for utilities. In some ways, not really clear to me that this company in and of itself is what matters. It's something that just kind of refocuses people's attention. Oh yeah, remember utilities, remember the data center narrative. Well, it's back, and I think that's what it was. This was a kickstart to push people's attention back in that direction. And then the other thing I mentioned about sentiment, I mean, if you look in this, the things from the American Association of Individual Investors or the National Association of Independent Investment Managers, both of those, they publish like these weekly reports in terms of how people are positioned or how people view the market. And both of them have seen significant pullbacks in terms of sentiment, which means that even with the market hitting highs, people are less exuberant or feeling less optimistic, which again, potential wall of worry. That is the title of our webinar today. The potential, are we climbing another wall of worry? All right. And the other thing is that, energy, if there's any sector that you want to see doing badly, it's energy. If you're bullish, that is. And here we are again looking at energy. We're going to get to this with XLE. We had talked about the potential for this thing to kind of peter out, and it's happening. We have oil, the OPEC plus increased production, and they're expected to do it again. So these things remain overall pretty important. What did briefly mention here also, if you look at our MT breadth, this is from our market trends webinar. Let me see this thing. Come on. I turned off my trade station just so I didn't have any issues with my streaming. But basically, the key thing is the advanced decline line here. Not quite to a high, but still trending higher. So we're not getting any kind of bearish divergence or anything on the breadth to make us be worried. So that was just another thing I wanted to talk about. But energy here, as we look forward, there's not a huge, as long as nothing blows up in the Middle East at this moment in time, we're in a situation where if you also look out to the future, not only do you see the potential for rate cuts, you also see the potential for energy going lower. And that is also something that can be positive for people who are looking for lower interest rates. The other thing that was also interesting is last week, looking at our article, there was this big rally in this stock, ALB, a lithium company. There was another, at least one other occasion, maybe two others. What's happening is China basically said lithium prices are too low. We're gonna basically force the people who make lithium to scale back production. And we've seen this actually in the last 2 years. China has been reining in production to support profits. Before they just dump stuff on the global markets, just selling stuff cheap and all the whole thing that kind of a lot of people didn't like about the way China was producing things. Now we actually have seen a different kind of China. We've seen a China that has been more disciplined in terms of protecting prices and profitability. And I think it's kind of interesting that the rally in ALB, which was one of the big gainers in the S&P 500 last week, was at number one. It was number 3 on the list. It was because of a move coming from China. So again, it's just interesting to see China is delivering positive impacts on the market with these rare earths and with the thing of lithium. And, I think it's, we said last week that we thought that there's a market trends. We said we thought the surprise might be China. And so I want to just kind of point that out. We did a trading view idea on Alibaba you can look at, but we're not going to get into it too much in this webinar. But the point is that China, continues to deliver some positive sort of catalyst in the market. And the last couple of things I'm going to add before we get to the actual indexes is we continue to see silver hitting a new high today. Going back to like 2000, more than a decade ago. So I think right here, there are some silver miners people might want to look at. We recently talked about wheat and precious metals, WPM. All these stocks are kind of in a tight kind of sideways movement. And I think it's interesting here just to see what's been happening with silver. We also had talked about what's happening with some of the housing tech stocks like Open Door Technologies. We were talking about it was down around $1, not close to $5. There is something happening in housing. People probably don't want to believe it. You can look and hear all sorts of horrible things about the housing market. But I think right here, if we just look at it, the housing, index is trying to hold these levels, from back in 2023. And if rates do move lower going forward, I think that's something that people just need to realize here is that there is potentially the beginnings of buying in the housing industry. And I think we need to realize that. We also have a European Central Bank meeting on Thursday. So right now we kind of see continued pressure on the dollar. And this is something where we had talked about how it had completed. Go to the weekly chart here, the DXY, and you can just see we had talked about it completing this kind of downtrend, and it did bounce, and now it's like sitting. And from my perspective here, I think we just have to realize that the ECB, if there is going to be a catalyst, it's going to tilt rates one way or another. We have Powell speaking tomorrow morning at 8:30, an ECB meeting on Thursday. I'm not sure what to think. And I would never make a prediction or anything like that, especially something like currencies, which is not my specialty. But I do know that things tend to happen on events. And when you have all the news leaning one way, I think, there is the potential for things to revert. And so I just think, if Powell comes out and kind of says what he's been saying, which is essentially that we're going to cut at some point, but we're not in a hurry to do it, and the ECB comes out and says we're going to cut and we're dovish, this could actually still create the potential here for some rebound in the dollar. So I still think people need to, be kind of people. The overall thinking here is that yields. The dollar's at a spot where it has priced in a lot of bad news, and when you look going forward, the Fed is getting toward a rate cut, but they're not, screamingly dovish, and other central banks are more dovish. So I think we're at a spot here where there is some potential here for a surprise upside in the dollar. And I want to just kind of remind people that the Powell speaks tomorrow morning at 8:30, and then the ECB is on Thursday morning. Okay. So now as we go to the S&P, we go to our weekly charts here, the S&P. Basically, what's really interesting to me here is, I need to actually move up this support level. It was actually 62.01 is really the level now that has stepped into matter, 62.01. That was that low from last week and again from 2 weeks ago and last week that it held. And at this point here, this is something where we have this tight, the breakout and the tight continuation is just inches higher. And so from my perspective here, there's nothing that really gives us much sense of this needing to do very much to the downside. The moves may not be particularly big, but it's in a spot here. This is kind of what you expect when you see a low volatility market, when it can simply kind of sit and melt higher with individual areas, starting to come to life. I'll just remember also that, the tech is leading again, which is a third of the index. Tech is broken out, as we're going to see. So the key sectors that would be supportive of upside are being supportive of upside. If we look at the Qs, it's almost exactly the same thing here. We have more or less a confirmation of a breakout, but of course we have a lot of earnings coming up. So, from my perspective here, this is something where the weekly chart does give us an overall sense that the trend, the longer term trend, has that bullish upside continuation. However, with a lot of earnings and things like that, this can be the kind of market where this could pull back on, numbers come out and then, people sell the news. And then very often you'll see with tech stocks and with growth stocks is they rally into the news, the earnings come out, they're good, the stock drops a little, and then basically a week later it stabilizes and then it continues higher. So the response, as we see with the breakout here in tech and the NASDAQ with earnings coming, the actual opportunity given to people may be short-term weakness as people sell the news when we look at earnings, followed by the opportunity for entries after people sell the news and they come, kind of pull back, hold, and then continue. That often happens. So that's how I see Qs here. Now remember, you can use TradeStation. In our 2 weeks ago in market trends, we showed people how to follow earnings and plan for earnings season using Radar Screen. If you want to go back and look at that, it's on the blog also. So the Dow here is, I think people might view this as it has potential for a breakout here. This is something that it's going to be probably based on the numbers that come out. And I think this is something where people might want to wait for a more clear breakout. If for some reason the market does want to pull back, people might actually look at this and see this as being stuck at resistance and actually seeing more downside risk. So I think overall here, this is something which has a positive overall market, like chart setup potentially, but it has no clear confirmation or anything on this. So at this point, the Dow is just sitting and waiting for some kind of confirmation. Now the Russell here is also kind of still stuck below these levels. And from my perspective here, this is something where this is less of an earnings story And this may have more kind of struggles ahead of it. And people may be more focused on the major earnings narratives now. And we might need to be getting closer to that September, potential September rate cut before this really starts to interest people again. So I think right now, this is something that might be kind of sitting and not doing very much. If you look at the ratio of the Russell to the NASDAQ, you can also see here, this is a quick ratio chart. There's really nothing here giving us a sense of the Russell turning higher against the NASDAQ. This is a ratio of the two. So at this point, things do seem to confirm that the sentiment favors the the large caps and the NASDAQ, the growth stocks over the Russell. Now, the 10-year Treasury yield is kind of interesting here because it's made this high kind of basing pattern here, but it also has pretty much stayed. I mean, this high last week was below this earlier high, so this is now in a very tight spot, and I think we just have to wait and see. I mean, there is always that fear that we're going to see like a repeat of 2023 when you had this huge summer surge in yields to drag down stocks. But I think now we're not getting really clear confirmation of that. We didn't close at the highs last week. We're still kind of stuck below the level where we were in May. So my view here is that this is something that's highly neutral that needs to be watched. But this has the potential to more or less kind of peter out here and stagger lower, and that could be positive for stocks overall. So I think right now with energy struggling and maybe a lot of the tariff stuff kind of known and happening, this is something where, as we get toward the potential of a September rate cut, this might be something here where the 10-year Treasury yield can turn around and start pulling, heading lower. And I would say during earnings season, it could be just sitting and drifting as people focus on earnings. But then as we start getting into August, and then we are going to have, of course, we will have the Jackson Hole speech by the Fed. At the end of this month, we'll have another Fed meeting as well. So then we're going to have those catalysts. And then on the other side of that, that's when we actually get to, maybe the potential, I would say, as we get into kind of September, people might see more of that sort of, potential thing. So I think it's important to realize we have the ECB on Thursday of this week, and then Wednesday of the following week on July 30th, we have that next Fed meeting. We also have GDP on July 30th. That's another thing. So those are items here that as we get past those items, as we get kind of through those and we get the commentary on those, I think that will start to influence rates. But for now, the focus is on earnings. So that is the TNX. Now, materials are interesting here. And there has been a lot of positive news on these. And from my view here, people might want to look to see if we actually can close above, I mean, to me, the closing high is what matters here. And I think people might want to look at 92.86. That was a weekly close back in early July. Here's this kind of resistance zone. However, we're facing that resistance zone and we're not failing at it. So from my view here, this is something where people might actually see the potential for some continuation in this, given the economic expectations. So I think materials here could actually be in a spot where they might actually give people some positive sort of surprises here. This is holding near resistance. So I think people here might be surprised by some strength coming out of materials as we move the next week or two, especially if we can close above these levels across here. In the weekly close back here from December around 92, but I think we're in the range here. We're a kind of price range here between kind of 91.5 up through kind of 92.5. People are going to potentially look where if we can be closing above that this might actually turn into people might view as more of a real breakout. Now the XLC. Communications, we talked about this has such a healthy chart. I'm pretty sure last week we noticed and we talked about how it was holding that high from February, held, it bounced, everything kind of performing as we often kind of discuss about this one. This one has, as we've said, a very healthy long-term weekly chart, and the that's pretty much being confirmed as we speak. So at this point, we have meta earnings and other things coming up, but things still here do kind of lean in a positive direction for communications. Energy, on the other hand, another lower high. This rising trend line on the weekly chart has that potentially become a bearish flag. So from my view here, oil is back to its old shenanigans. I would say that in some ways, oil's at a special place for the bears because, if you go back to where it was in like 2016, 2017, when OPEC was pumping oil and demand was weak and the world was getting flooded with crude, you know, that was a great time to be shorting oil and shorting energy stocks. And what's interesting is that coming out of COVID, COVID gave them gave OPEC a new discipline. And that's kind of held together until the last few months. But now, when you look at the most recent news coming out, I mean, these guys are back to where they were, which is basically you have a bunch of countries that want to make money. They don't want to be playing ball with each other. And a lot of it has to do with weird dynamics between, Saudi Arabia and Kazakhstan. But at the end of the day, the key thing is there is a political pressure inside of OPEC to pump oil. There's no discipline. There's no desire to keep rates low. And, as long as no geopolitical issues pop up, this is something here where, we could be looking at the potential for XLE. Here it is up at 86, a move back toward 80 or 75, might be something people see the potential for. So I think right now XLE is in a spot where it has this potential bearish flag on the, on the weekly, you can see it, but on the daily here as well. And so I think it actually opens up questions about a return back toward these levels in the mid 70s on the XLE. Now, XLF, we had some interesting news. Here's another one. There's so many things. XYZ is all these alphabet soup here. Block, the old Square, Jack Dorsey's company, is joining the S&P 500, and it's going to join the XLF as a financial. It's not a tech stock. So it's just kind of interesting. We have this gap here. I'm not sure what to make about Dorsey's company overall, Block, but I wanted to just mention that it is an interesting news point for the sector. Now, look at the XLF on the weekly. We've also talked about how this has a very, strong sort of support area that more or less it is held here. We had a false breakdown under it last week. So from my perspective, XLF remains in that overall kind of, positive setup with, the potential for increased Wall Street activity and just improvement in the banks and everything else. Overall, it kind of has this confirmed breakout. And I do think, though, the one thing about it is, one of its biggest holdings is Berkshire Hathaway, which has been struggling a lot. The problem with XLF is it now has a lot of property and casualty stocks. So from my view here, this has overall, a positive, essentially on the weekly chart. People could look for this upside continuation, but at the same time, it's become like a kind of less meaningful sector because in some ways with the growth of property and casualty stocks, it's become less cyclical. But overall here we do have, what could be a confirmed breakout above these previous closes. And so I think that does remain in effect. People might be looking more for the individual level, the banks and things like that, if they're actually looking for performance. That's the financials, XLF. XLI, industrials. We also had talked about how this had a clean breakout. And again, this is something where the drift to the upside. However, when some earnings come out, this is something where, you might see, I think Caterpillar report, these names coming, Caterpillar, Boeing, these guys are all coming, Honeywell, all those kind of big industrial names, railroads, and, they all be coming out. So I think it's one of these things where overall the bias here, it confirms, and we've talked about this, once we had that close at an all-time high, which was right here, which is that key pattern we look at, a weekly closing high, it has, continued to melt higher, and with the economic picture and everything else, XLI seems to continue to have that structure. XLK, I saw this article last week about how computer shipments in the second quarter were the best in 3 years. So again, we have the tech side with, all the hardware, and there's been some strength in some of the software names recently. So I think overall right here, when we look at the XLK, also seems to have a clear sort of, breakout of the weekly chart. However, with earnings and everything else coming up, you might just look for some chopping, and this one is now up around, the current price on it is around, 262.5. So, chop downs toward kind of 259, which would be that kind of weekly high back the week begun July 7th, modest chop downs of 1% to 2%, kind of looking to hold here, is something that is entirely possible with earnings season and the way, things often happen around earnings season. XLP, consumer staples, we've talked about this as being just kind of languid and drifting. And from my view, this is actually something that does have, risk of coming back down under 76 here. So I think we need to realize it is holding across here, but it's not making new highs when the rest of the market is. This is stuck in range bound at a time when the overall market is breaking out. And that could mean that at a certain point in time, it does actually take a hit. So in my view here, with earnings coming and everything else, this might actually see some liquidity events involving downside. Now, real estate investment trusts, on the other hand, with the potential sort of peaking of interest rates, this has been a tricky one. It's been moving sideways and essentially has this, this resistance line here. It was a weekly close back in the beginning of March, but this is now in a very tight range, and this has the potential now to break out and escape, through this trend line. So I think now we want to watch for some potential upside in the REITs. But I also would mention that American Tower, AMT, this stock has been basically in a tight range as well, and this might accelerate. These guys, the wireless towers, I haven't heard people talk about them as AI plays, but at a certain point in time, you have to wonder, will AI, drive demand for wireless communications? Maybe it won't, but from my perspective, it seems like it's more likely to have a positive effect that has not yet been discussed. So you can just kind of see this as something that people suddenly say, hey, this is essentially a tech area, and tech has this growth stimulus that's not happening there. So that is XLRE. XLU, this is the breakout. We were saying XLU. We said if it closes above 83 on the weekly chart, that could give a signal, and here we are. So from my perspective here, so like XLU, this is an area where there could be some modest sort of chopping around here. For a certain period of time, it is somewhat overbought. If you look the 10-day moving average, you maybe look for some shorter term moving averages like the 8-day exponential or something to kind of catch up. But essentially here, this is kind of a textbook breakout in the XLU. So I think this is one that really stood out to me. It joins the other sector, a few other sectors like financials, technology, industrials that have broken out. There have been a few others. Look in our article. We actually talk about that more clearly. I'm running out of time. XLV, healthcare. We had basically said when this thing was high up in its range, we said it could probably go low in its range, and that's now getting lower in its range. So basically here, XLV, there's just a lot of issues in this industry. And I think we have to realize that this is a potential topping pattern on the weekly chart of the healthcare ETF. Higher, this potential head and shoulders. From my perspective here, there's a lot of troubled sort of, news in this. And the price action is not giving us anything that can make us think that this is pointing higher. If anything, it does seem to be setting up for a longer term reversal on the weekly chart here. So XLV continues to be kind of the weak man, the sick man of the index. Now, XLY, I also want to point out, because this one to me, I think is really interesting. It is just sitting and building here above this low from back in January. That January low was important on a lot of charts. If you look at like SPX, you can see this January low right here. You can look at how we basically got stuck at it in March, and then we broke above it and had to consolidate in May. So go back to XLY. It's just now breaking that respective level. You can see it got above that basically January low, got above, chop, 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 and now it's squeezing to the upside. So I think right now, when we look out to the future, what if rates come down a bit? Well, what does that do for housing? What does that do for Ford Motor? Look at this pullback in Ford Motor. We might do a trading view idea on this. That strong results came back, pulled back. Things like Ford Motor. When you see things also like some of the retail names, the housing names, Tesla, which now is kind of morphing more in the direction of the robo-taxi. They report earnings on Wednesday afternoon. Amazon reports earnings, I think, on the 31st. So these names are coming up. So from my view here, there is a lot of bad news priced into consumer discretionaries here. Elon Musk put out a note about having strong Model 3 sales. And then also last week they had strong registrations in China. So there are some interesting things kind of happening here with XLY kind of breaking out, and a lot of bad news priced in as people start looking the second half of the year. There's going to be talk about back to school. There's going to be talk about Christmas and holiday shopping. There's also the kind of strength in some of the leisure and travel names in here, and things like Tesla and things like home builders. So right now, I think actually consumer discretionary is an area I'm looking at, which is very tight and has maybe some potential for some surprises to the upside. So great to talk to everyone. Sorry for running over. We'll be back on Thursday afternoon in Market Trends. Everyone has a great day, and I'll see you Thursday.